How's it going? It's Derek, and I'm giving you all a quick update regarding the zero gravity strategy. A couple rules that you could follow that can actually help you increase your accuracy. Now, the reason I'm even making this is because, again, the zero gravity strategy method it does have pretty good accuracy, especially if you're in a nice, where you see the market cycling and in a nice um, consolidated market or range market. It works out really well. You can see the price. It's a nice oscillation right there. And it works out a lot in these cases, but 9 times out of 8, when I tend to lose my positions using this method, it's because of something like this. All right, so you see, all right, the red candle, it goes down. I've already gone over this. I don't want to go super in detail, but as we know, when the red candle crosses down into oversold market, and you also see the stochastic oscillators oversold, you're getting ready to do a call position. And you do the call position when the blue line in the Keltner channel, when the blue line in the stochastic oscillator crosses over with the purple line, or I guess it'd be the orange line in a lot of your cases, right? And a lot of times it will work out in your favor. It's pretty accurate. One second, I literally just lost my position. I don't even know why. Here we go. All right, here we go. So a lot of times it will work out in your favor. So as you can see, where was I? Oh man, I just lost my position. Man, I really wanted to show this because, all right, here we go. So in the green candle, it goes over bought conditions. Also, the stochastic oscillators overbought conditions, and then you see the blue line cross down. That's a good sign that it's time to do a put option. But a lot of times, again, 9 times out of 8, when I end up losing using this strategy, is because something like this happens. Like I just said, you see all of the rules are being respected over overbought conditions. It shoots back down, right? But then something like this happens. You see a green candle form. You see the lines. There's a good healthy distance between the two lines in the stochastic oscillator. So okay, you're like, okay, it's time for us to do a call position, right? But then what happens is you get faked out. You see the green candle form, and the lines are beginning to cross, but they don't cross over just yet. But you try to get a good entry point, so you enter right here on this candle. And then the next candle happens and you get faked out. And then the red candle just become, and there's no chance of you winning your position. And it is one of the worst things that can happen. And every time I've ever lost with this strategy, it's because of something like that. It's not even because I lost, because it was just staying still or something like that. It's literally been because the market doesn't, it refuses to, do what you think it's gonna do. Because here you see it goes oversold, right here, and it shoots back up. And then it goes overbought and it shoots down. Even here, overbought, it's starting to go down, right? It reverses down, and oversold, it reverses back up. But in this instance right here, when you want to enter, you get faked out and the candles continue to go down. Now this is called a kangaroo tail. It's still going to reverse, but it's not going to reverse in time for your trade. All right, so when we're doing a 2-minute strategy like this, we don't have all the time in the world to wait for retracements. It's a very short window. It's a 2-minute trade, and we need momentum. So what I realized after testing the strategy over and over and over again, like I said, the best way to become efficient in anything, you just have to keep practicing at it until you get good at it. That's just the way it is. But what I realized after testing this strategy a lot of times, and I think, okay, the candle's starting to go green, the lines are starting to cross, but I still end up losing. What I realized is that one of the most important indicators to look at is this 200 moving average. All right, I went over the different indicators I use. I use the Keltner channel. It's 20 and then 10. Those are the settings. The moving average is set at 200. And then we have the stochastic oscillator set at 14, 3, and 3. Now, the reason I set the moving average at 200 is because it's going to give you a nice long-term trend. And when the candles are consistently below the 200 moving average, that means we're in a downtrend. Here's an uptrend, right? You can see that the candles are consistently above the 200 moving average. That means we're in an uptrend. It doesn't last forever, right? Eventually, it's going to break out. So, you see, the red candle crosses under into oversold conditions, and also the stochastic oscillator is an oversold, right? But then the lines cross over, right? You see how the lines actually cross over pretty cleanly. I'll zoom in a little bit so you can see. See how the lines cross over, right? So the lines cross over. That's a beautiful crossover, by the way. If you see the way there's like a lot of distance and it's like sharp angles, a lot of times I'll actually enter my trade once I see this blue line start to make a sharp angle, and I trade obviously in the opposite direction. But when you see a nice, parabola shape, start to form, you're in a nice clean, consolidated market, right? So the red candles cross under into oversold conditions, stochastic oscillators and oversold conditions, and then you see the lines in stochastic oscillator cross over, and you're like, boom, perfect, let's do a call. You win your call, right? And then of course it reverses back down. You see the lines cross again. That is a beautiful textbook reversal right there. Textbook. That is a picture perfect reversal right there. That is what if I wanted to do 100% of my account, I would do a trade right there. And then you see, and it reverses back down. Correct. What it's really doing is the price is correcting itself. So it's an overbought conditions here, textbook reversal, back down, and then it becomes oversold again, right? It's oversold in the Keltner channel, but not in the stochastic oscillator, but it still has a very strong reversal, back up, and then boom, it's back down into in oversold conditions in both sections, both the Keltner and the stochastic, and you see the pattern continues. But then something like this happens, where you think that the market's getting ready to reverse back up, because you see this green candle start to form, but then you get faked out, and then something like this happens where it sinks down and it just keeps going down, or even something like this right here is another example right here, where you see a green candle start to form. So you enter here thinking it's going to reverse back up in your favor, but then it just keeps sinking down, and there's no chance of you winning your position. And that is one of the worst things that can happen. It happens to me. Especially when I first started doing this method, it would happen to me all the time. And it would make me think that the broker was like against me. Something like this would happen. You see a green candle form, like, oh man, it's time to enter for a call option, and then you get spiked down. Again, I always say to look for support and resistance. So the support would be somewhere in this area here. So it would work out in your favor if you looked at that. But a lot of novice traders will miss that. But there are also times like this, where you see there's a strong support right here, and you think, okay, we're getting ready to reverse up. Of course, it's actually a really good market to have traded in, because the lines are very clean, right? The lines in the stochastic are very clean, very sharp angles, so you can tell when it's going to reverse back up. But let's say you're in an instance like this, right? And you think the candles are getting ready to reverse up, right? Everything, the lines, they cross each other, it's starting to go up, but then boom, it just sinks down. You're thinking you're going to make a call option, and it just sinks down, causing you to lose your trade. It's one of the worst things. Even right here, see, you think it's getting ready to go, and then it sinks back down. Tell me if that's happened to you. I'm trying to find other instances. The thing about this is it's just so laggy right now. Even something like here. Oh, this is actually perfect right here. All right, so you see the red candles are forming. They're going through into sold conditions, and you're like, man, it's getting ready to reverse back up, right? and then you see a nice engulfing, a bullish engulfing candle form. The lines do cross, but in this instant, you get faked out. This is actually the textbook example of what the worst thing to happen is. This is what happens. And it's the worst thing because you think it's getting ready to, correct itself, but then it ends up just sinking down, causing you to lose your position. Of course, it's eventually going to go back up. But even here, again, you think it's going to, you think it'll be good if you enter here. But if you enter too late, again, it sinks down, causing you to lose your position. It's not until you get to this point right here that the candles finally decide to go up in your favor. So that is one of the worst things. I call it the fake out, the breakout fake out. When you think that the pattern's going to continue and it just breaks the pattern, causing you to lose your position because it just sinks down. And there is a way to avoid that. And this is something that's actually going to be able to help you gain a little bit more accuracy. So like I said in the previous video, the 200 moving average basically tells you if you're, again, like I said, if the candles are consistently above, you're in uptrend. If the candles are going right through the white line, that means you're in pure consolidation. It could go either way. And when the candles are below consistently, we're in a downtrend. So a good way to reduce the risk of getting a breakout fake out is when you're below the 200 moving average, to only have a strict bias towards only doing put options. And the reason I say that is because it's less likely that the candles are going to fake you out on the going up. Right? The candles are less likely to fake you out going up than they are going down. You see how you get faked out a lot going down, but you rarely get faked out with candles moving upwards. So if you were to have a strict bias towards put options, you're most likely going to win your positions. The reason why I even called this the zero gravity method is because I likened it to a gravity room. Each confirmation basically having a different strength of gravity. And the strongest gravitational pull is the 200 moving average because that is where you see the long-term trend. So as you could see, when we're below the white 200 moving average, the candles tend to cleanly retract down. There's a lot more momentum. It takes way less candles. As you can see, it only takes 2 candles to reach from where it was overbought conditions to sink back down. And when it comes to these 2-minute strategies, especially this method right here, you're going to want as much momentum on your side as possible because one, it's going to give you a little bit of peace of mind. Trust me, trades work. You're a lot happier trading when you enter for a put position here, and by the second candle, you're all the way down here. You're pretty much going to win. Versus, let's say you're doing a call position, and because it's reversing back up, but guess what? You enter here, and a call position, you're only somewhere in this area, area. It can reverse back down on you, and you're like, oh man, it's going to reverse back down. But notice that when we're in a downtrend, when we're below the white line, the 200 moving average, the candle, the bearish engulfing candles are a lot bigger. You see, remember, each candle is a minute, so each minute is more momentum downward. Because again, there's a stronger gravitational pull on the downside because we're on this is considered a downtrend when we're below the line. So I tend to only do put options when I'm below, and then when I'm above the 200 moving average, I have a bias towards call options. Because as you can see, see how this not really getting faked out at all on the up. Once it crosses, it's going back down. Once it crosses into overbought conditions, it's shooting down when it's when it's on the other side. Also, I want to let you guys know that this rule regarding using like the different trends to your advantage, downtrend versus uptrend, it works a lot stronger the farther away you are, the farther away your candles are from the white line. Let me show you guys something. it's just really slow. 1 second, guys. All right, so something like this. All right, you see how the farther away we are from this white line, the stronger the uptrend is. See how much more steep that is because we're farther away. There's actually a lot better scenarios I could show you, and that's when you're just in like long-term uptrends or downtrends, depending on what side you're on. Something like this. All right, you see this? Oh man, sorry, it just scrolled away. All right, so you see, here it is, right here. All right, so you see this? See how it's getting far away? See how this is like a long, very steep drop into the red, into the I call it bear country, and it takes a really, really long time for it to retrace back up into, you know, with the green candles back out. But even then, it just sinks right back down. The momentum's not as strong for it to continue going up because it's a downtrend. And then finally it retraces itself and it corrects itself. But then again, you see it's struggling to go up because the momentum is more down. But the closer we get to the white line, as you can see, the more, I guess you could call it, more ambiguous the trends become, and it starts to swing. It shoots right up. Even here, the reverse of this, I'll show you if it ever lets me. Or here we go. All right, so you see there's the moving average right there. I don't know why it's such a sharp turn right there. It's really weird. All right, so as you can see right here, that's really weird. That moving average isn't right. I mean, it is, but I don't know. It could be because it's, again, I said, you know, pocket option just lags when I'm recording. I don't get it. All right, so here we go. You see how like the the bearish engulfing candles are getting really close to this white line, the 200 moving average, and you see how it just shoots down. That is something else I want to tell you guys. When it comes to using this strategy, try to use this strategy only when the candles have a nice distance between the moving average. If the candles are a little bit too close to the moving average, it becomes a little ambiguous and it can go either way. Like, unless the moving average is right here and the candles are oscillating around it evenly, I would just avoid it at all costs. The farther away, the better, because the farther away means the more likely the candles are going to respect the rules, right? So again, this is a downtrend, which means, right, you see, this is oversold. Sorry, it's overbought here. All right, and then when the lines begin to cross each other, it shoots down. It does retrace up a little bit, but then it shoots right back down. And then you see down here, it's trying to retrace up, right? You see the lines cross each other, but then what happens is you get into these really strong engulfing candles, which means, you know, I consider that a little shaky, and I really try to avoid having, you know, bullish engulfing candle, bearish engulfing candle, bullish engulfing candle, right, in a row, because that's a lot of room to lose your position. What you want to look for is candles having a lot of distance between them. So again, you see we're getting like a little close to the line though. Let me see if I can find a better scenario for you all. So something like this is like a perfect scenario where we see there's a lot of distance between the white line here, the white moving average, 200 moving average, and you see how strong it's actually surfing down. When it's far away from the white line, that's when you know there's going to be a really strong pull towards put options. So you can even see it's doing a call option just because you see the candles cross. It's just, see how it's not really, you try to do it, there's a really strong chance you might lose your position. So let's say you see the candles, they're starting to retrace a little bit, they're starting to go up, I think it's going to correct itself, but then boom, you shot right back down with a red you know, bearish engulfing candle. You lose that position. You see it goes green a little bit more, okay, but you lose that position. It's really hard to get the momentum going in your favor because you're on the wrong side of the white line. But on the other hand, what you can do is wait until Don't even enter when you see the green candles going up, because again, you could get faked out and it could still sink. What I do now is I'll wait for the candles to finally become over bought, and then I know it's a good time to enter. So I'll wait for, you see, the nice clean turn, a nice clean curve, in the stochastic oscillator, and then boom, see that nice strong reversal right there, and then it reverses back up. I wouldn't do the reverse back. I wouldn't enter in the reverse back up, but see, you won your position there, right? But then you see it again. You see the lines cross, and then boom, you win your position again. But on the other hand, if you're trying to do call options, there's not that much momentum on the upswing. And the truth is opposite for uptrends. I'm going to see if I can find one of uptrends when we're on the other side of the 200 moving average. So as I said before, when the candles are consistently below, we're in a downtrend. When the candles are consistently above, that means we're in an uptrend, right? So what does that mean? That means we're on an uptrend. We're going to have a bias towards making call positions. And the reason why is because of this. You can see there's a lot more momentum on the upswing than there is in the downswing. So, you know, and I say this because of something like this. Let's say you see we're in an uptrend, but the market's a little bit consolidating, right? So you'll see, okay, it swings up in our favor when it becomes oversold and oversold here. It swings up, all right? Then it becomes overbought here and overbought down here. It swings back down, all right? And then, all right, it goes back below. All right, it swings up, right? And let's say you're looking at the markets and you're like, okay, it's been respecting the rules every time, you know, the candles cross into overbought conditions or oversold conditions, it reverses. But then something like this happens. You see, and you know, a bearish candle start to form. You see the lines in stochastic oscillator start to cross, and you think, man, this is the perfect time to enter for a put position, right? And then what happens? It swings up out of your favor, and you end up losing the position. And it's not until you get around here that it finally decides to go down. And like I said before, when you get faked, again, this is a fake out. So what happens is you actually got faked out. You thought it was going to go down. It ended up going back up, and you lost. That is a fake out. Before, that was a bearish fake out. This right here is a bullish fake out. And what I mean by fake out is you think that it's getting ready to, you know, reverse on you, and then ends up just, the trend just keeps continue. And why does it continue? Because we're in an uptrend. This is especially true once you see the 200 moving average becomes more steep. The steeper it is, the stronger the uptrend is. The farther away the candles are from the 200 moving average, the stronger the trend is. All right? But a good way to use this momentum in your favor, which is actually going to help you win more trades at a higher percentage of the time. Remember what I said before, when we're below the moving average, we're only going to do put positions because the momentum's in our favor. So what does that mean when we're above 200 moving average? That means we're only going to do call positions because the momentum's in our favor. So as you can see, you see the a red candle, it crosses down into oversold conditions. Stochastic oscillator lines also cross down oversold conditions. The lines in stochastic oscillator cross, and you can see that really, really sharp angle right there. Boom. Look at that momentum. It just shoots up. You won that trade. Really less likely to even lose that trade because look at that momentum. All right? And then you think, okay, it's going to swing back down, but nope, you get faked out. So only do call positions when you're above the 200 moving average. Even something like this, where the candle doesn't even close in oversold conditions, but it still shoots up, as you could see. So I hope this sheds a little bit of light on this for you. And also, as you can see, once the candles start getting a little bit closer to the white line, like I said before, when the candles start getting too close to the white line, that's usually when the trend's about to break. And you can see that strong gravitational pull towards the downside. Now we're in a downtrend. We just entered bear country. So I hope this makes a lot of sense for you all. And you can see I did multiple charts, and you can see the opposite is true. Uptrends only do call positions. Downtrends only do put positions. Let me see if I can find another one for you all here. See this? The lines crossed. You think it's getting ready to be in your favor, and then boom, It just crosses down into bear country and you lose your position. See that? It was actually the perfect. I should have started with this one. This is actually the perfect chart to show you. And you can see the momentum towards going back up is very low. Meanwhile, like I said before, you just wait for that. You just wait to finally become in over bought conditions, and then when you finally decide to do a put call a put option right here, look at that momentum down. You won your position. But if you try to do calls, in some instances like this, it could work for you, but in most instances, you're gonna just end up getting faked out right here. It's just not worth it. At the end of the day, you want to make sure you have as many signals possible at your disposal to make sure you are most likely to win your trade. So you can just see how the momentum is so different towards calls versus put options, depending on what side you're on. It's all about momentum. You can see how big the green candles are above the line. See these big green. Remember, each candle's a minute. Look how much this is jumping up in a minute. Red candles are a lot smaller, as you can see. There's not that much momentum. But when we get to the other side, you can see the red candles have they're the largest candles are red instead of green because they have the momentum. See how small the green candles become. You get one or two larger candles here and there, but that's usually it's retracing right back down anyway. So hope that makes a lot of sense for you all. Don't want to ramble, don't want to bore you. I just wanted to give you guys an update, a little strategy that I use to make the method a little bit more reliable, a little bit more accurate. All right, have a great day. Take care. Peace. Out doing at least a couple of trades just to show you how this method works in real time. So as I said, once the candles start getting really close to the line, unless it's getting ready to reverse, unless there's indicators that it's about to reverse, which there are right now, it could actually shoot up and the trend could continue. It could break out and it could go back into uptrend territory. And I'm only saying that because, as you can see, it did it right here. This is actually a pretty good resistance level. So let's see. I'm just going to see where this... I'll give it one more minute to see where this candle's going. And again, I'm doing 1 minute candles, 2 minute trades, or 2 minute positions. Yeah. Like I said, see, as the candles get closer, the gravitational pull can reverse up. But oh no, that one's a little bit too close. I might look for another position. Now this one could actually end up going in my favor, but because it's so close to the white line, I'm not going to enter. Let me see. It's starting to curve though. You know what? I think this is going to be a really good position right here. I'll just take it right now. You guys can see the lag. My entry point was all the way up here, but because again I'm doing this, I'm screen recording on my Mac for some reason, man. I don't even know where my entry point even is. I don't even know if I'm even winning the trade right now because it's just so laggy. It's crazy. But yeah, I should win this one. There it is. I see it now. It's starting to go back to normal. That was really weird. But like I said, we're on the right side of the white line. I have a bias towards downtrends. Sorry, I have a bias towards put options because we're in a downtrend. So we should win this one. Yeah, you see that? It's a little laggy though. My entry got really messed up with this lag. But I'm gonna win this one. Again, it is in the downtrend. So like I said, I have a bias towards put positions. I was supposed to enter way up here, but because I'm screen recording, my entry got really messed up, which sucks, but I should win this one anyway. You know. So I ended up winning that one. See how it just shot down? I won that one by a lot, actually. See? Just won that trade. um, didn't get faked out. Why? Because we were on the right side of the white line. Even though we were cutting it close, we were pretty close to the white line. I mean, what you want to do is you want to have it be have a little bit of distance. Let me see if I could find a trade like that, and I'll enter it for you all. Yeah. Let me see. I'm not going to do that one because even though it is reversing back up, it's not going to be that much momentum because my bias should be for put. Now, like I said before, see how even when it reverses back down, you only have a few candles and then boom, it's right back up. Like I could do a put position here, but who's to say it won't reverse back up? It's a strong uptrend. But the cool thing is about this is, if you're reversing, if you're waiting for the trend to reverse in that, if you're waiting for, your reversal to reverse back in the direction of the trend to continue, then that is a really good thing that you could use to your advantage. Again, white lines too close there. And a lot of these other markets really just aren't. A lot of these things are really getting close. All right, here we go. All right, see this right here? This would be a perfect reversal. I would probably enter somewhere around here because that's where the resistance is, somewhere in this area. Let me see. We have a little bit of a distance, healthy distance between the candles and the 200 moving average, which is good. That means that it's most likely going to respect the reversal. It's most likely going to respect, when the reversal is getting ready to happen, it's most likely to respect it. We're just going to wait for this candle to close. Again, you don't want to enter your trades too soon. All right, you see how this is starting to reverse right here? See how it's starting to get a sharp angle right there? Sharp angle, see that? I don't even know where my entry was. I entered, oh man. Like I said, when it's really laggy like this, it's really hard to get a perfect entry. I was really trying to enter all the way up here, but because of the lag from the from the camera, the screen recording, it just messed up a little bit, but it's okay. See how it did the sharp angle right there in stochastic oscillator? First off, this is a picture perfect trade. Let me show you why. Number one, we're on the bottom, right? We're on the bottom of this 200 moving average, as you can see. Keep on, this is OTC I'm trading on right now. This isn't even the real market. OTC is a lot harder than the real market. So if this works on OTC, it's going to work on the real market, number one. All right, number two, the reason why I want to say this is a 5-star trade is because it fits everything that I say to look for in this strategy. Number one, you take inventory of which side of the 200 moving average we're on. We're on the bottom of the 200 moving average, which means we're in a downtrend, which means you're going to have a bias towards placing put options, right? All right, so as you could see, as soon as and number two, I saw that we went into, the green candle went into over. It's just so laggy. I can't even really keep up. So you see the green candle went into overbought conditions. Also, stochastic oscillator was in overbought conditions. Then I waited to see a sharp turn with the blue line in stochastic oscillator. That's usually a good signal. It gives you like a good 10-second window to let you know enter, because this thing's about to reverse on you. So even before it actually crosses, if you see a really sharp angle, and I just won that trade just now, as you can see, pretty awesome. But as you saw, that sharp angle came in the stochastic oscillator, and that was a really strong indicator that it was going to sink down. And you saw how when it reversed, it didn't just do a little movement here and a little movement there in the next candle. No, it just shot down. And that's the beauty of it. So I'm just going to go over it again now that my trade's done, because when I'm looking at my trade, sometimes it's hard to focus. That was a 5-star trade. That was the absolute picture perfect trade to look for. And there are so many reasons why. Reason number one, you see this right here. This is the 200 moving average. When the candles are above, you want to have a bias towards call options. When the candles are below, you want to have a bias towards put options, right? So which side of the 200 moving average are we on? we're on the bottom, so we're going to have a bias towards put options. Okay, so what we do is we don't rush the trade, we let the trade come to us. I actually put in a support, in a resistance line right here because I thought maybe it would continue to go towards the, the stronger, farther away resistance line, even though this is resistance right here. Where it ended up turning was a resistance, but I like to have a little bit of insurance just to plan it a little bit ahead, right? So number one, we're on the bottom of the 200 moving average, which means we're gonna have a bias towards put options. Number two, it was the perfect time to make a put option because the green candle went into overbought conditions. All right, and then it was actually at the it was actually at the support. It was actually at the resistance level. Sorry. I'm just so busy looking at trades. I want to enter this trade. I'm not going to enter it. All right, so this was the perfect trade. I'm going to tell you why. Number one, we were on the right side of the 200 moving average, like I just said. Number two, the green candle went into overbought conditions, right? And then the stochastic oscillator was also in overbought conditions. But what really sealed the deal was that I saw the stochastic oscillator, it started to form a very sharp angle. As I was talking, you should have seen this sharp angle start forming. That was my sign that we were about to get into a strong reversal. And of course, the most important thing is we were in a consolidated range market. As you can see, the candles were respecting the Keltner channel. You see, whenever they hit the Keltner channel, they did, they bounced back off of it. It's almost like a rubber band effect. You see nice clean lines in stochastic oscillator, a nice fat amount of distance, a nice wide distance, pretty much this entire channel right here. As you can see, a nice healthy distance between the lines, which is just awesome. As you could see, when the lines have a nice amount of space between them, that means that there's a lot of momentum. When you see the lines there's a lot of as you could call it, a lot of vertical momentum when you see the lines have when these lines have a good amount of space. See the vertical momentum? Whereas something like this, I'm going to reverse a little bit. You can see these are just a bunch of engulfing candles, opposite colors. The lines are a lot muddier. See, the lines are muddy here. But when you see nice, healthy distance between the lines in stochastic oscillator, they're making nice parabolas. And especially when you see a sharp turn like this, you know that the trade is going to reverse. That the candles are getting ready to do a strong reversal. So it really fit all the criteria that I do when I make a trade, and that's why you were able to see I was able to win that trade pretty easily. And you were able to see I didn't win by just a little bit. It wasn't a photo finish. It just shot down. So as long as you follow these rules, as long as you practice proper risk management, as long as you don't, overblow your account or anything crazy like that, as long as you don't get too cocky, don't win 5 or 6 trades in a row and think, you know what, I won, let's say you're betting $1 per trade and you win 10 trades in a row, right? And you get your account up to, let's say you're doing your account at like $500, right? And you win 10 trades in a row. Now your account's at what, 520? And you're like, you know what? I'm winning all my trades. Let me bet 250 on my next one, or even 100 on my next one. Because no strategy works 100% of the time. At the end of the day, the market's always going to do whatever it wants to do. And I say this in every video, and I say it to drown out the hype. I'm not here to hype anyone up. But at the end of the day, it's not about being hype. It's about really just like following a plan, and studying and staying consistent. And hey, you might be watching this video and you might find an indicator that makes my strategy even better. That's awesome, and it will work out for you and make it a lot more consistent. But at the end of the day, a consistent strategy can't beat poor money management, because you could have a strategy that works 90% of the time, and if you have poor risk management and you want to bet like 50% of your account or even 20% of your account, and it happens to be that one time out of 10 that the strategy doesn't work, you're going to be really mad, you're going to get in your emotions, and you're going to start revenge trading, and it's just a downward spiral. So I'm always going to say at the end of these videos, yes, the strategy is awesome. You can see it's working. You see this market right here is a beautiful, beautiful consolidated market right now. So this would be a nice market to ping pong in. But at the end of the day, this ping pong pattern, it's not going to last forever. It's not. Eventually, it's going to break out. My guess would be actually it's going to break out in the upwards momentum, because I could see this moving average is starting to sink down, which means at the end of this nice little consolidated market, these lines are going to cross, and it's going to move into. It looks like it's actually getting ready to do it right now. But that's also why I said to have a bias towards put options, because I don't know, because look at that. I could enter another trade right now and just win this trade right here, right? But that's why I said, have a bias towards put options in the downtrends, because you can see the momentum is just so strong. But again, like I just said, consolidated markets, they don't last forever. So don't think you could just ping pong and do this strategy indefinitely, because eventually the pattern is going to break. So practice proper risk management. Hope this sheds some light on this for you guys. I'll let this trade finish and continue and see where it goes, and then I'll end the video. So let's see how this trade goes. Yeah, because eventually I'm leaning towards the trend. I'm leaning towards the trend actually breaking out above. But when that happens, that's when the candles are going to be a lot closer to this white moving average. So we'll see. This thing is so laggy, it's ridiculous, man. I really want to do like more videos just like chilling and like recording my screen and like, but it's just so laggy. It's crazy. It is crazy how laggy this is. The good thing is I got a really good entry point. I don't know how I was able to get that. Actually, no, I didn't. My entry point's kind of bad. It's kind of trash, but I should win this one. I don't know. I think this trade actually ended, but my countdown's like a little slow. I don't even know if I won that one. Did I win this one? It's like I won it. So what am I, 3-0 in this call right here, man? It's crazy. But eventually, once this white line starts to get a little too close, that's when the breakout happens. That's another secret, because a lot of people are like, where's a good way to know when this nice consolidated market ends? Usually it's when you start to see the consolidated market start to get a little bit too close to this white line. Remember, this is the consolidated market within a trend, right? Eventually, this trend's going to start moving. It's going to appear to be moving upward, and this line is going to be appearing to move downward, and they're going to cross each other. Once the candles and this cross, there'll be a little time of consolidation, and then after that, it's going to be an uptrend. That's just how it works. But I hope this shed some light on it for you guys. You guys saw I won 3 trades in a row using this strategy. As long as you're patient, don't rush your trades. Don't think, oh, it just crossed over the green candle, because the person who has this is someone who has a similar strategy to this, but there's not as much nuance to it. What she does is as soon as it crosses, she just enters. And when you just do it like that, guess what? Oh, it went red. Let me enter. Oh, I got faked out. And again, remember the candles, 1-minute candles, 2-minute trades. Guys, have any questions? Just hit me up, message me, DM me, whatever it is, Telegram me, Snapchat me, call me, beat me if you want to reach me. Have a great day, guys. Take care.